Welcome back everyone. I hope you're doing well. And in this video, we're going to go over two of the small cap companies I just bought in my high risk, high reward, growth stock portfolio. Both of these brands have a ton of future growth potential. They operate in fast expanding industries, and because they are small cap names, they have the potential to go 5x in only a few years. These companies do come with a lot more associated risks, so I go in with very small positions relative to my overall dividend portfolio that now has a value of close to $97,000. So if you're new to the channel, I am the Gen Z investor and I'm a blue chip dividend growth investor who focuses on long-term share price and dividend growth. So my main portfolio that you can see here that is worth close to $97,000 is made up of blue chip dividend paying companies that I plan to hold for long into the future. But to get exposure to some higher risk, higher potential growth companies, I created a separate portfolio that now has a value of only $5,000 where I invest in the SPACs and the small cap companies that I do believe have a lot of potential to expand over the next few years and may see some very nice returns. So in this video, we're going to focus on two companies that I've just purchased within this portfolio that I believe have a lot of long-term potential and may see some nice growth going forward. And both of these brands have now fallen over 30% from their recent highs, so I bought the dip and added and created a new position for this portfolio. And before we take a look at that first stock, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And the first company that I added to this portfolio is ticker SEDG, which is SolarEdge Technologies, and the company currently trades for $255 per share, and they are up 160% on the 12-month chart, and the company now has a market cap at $12.5 billion. But as of late, they have seen a major pullback from their 52-week high of $365 per share. They have now fallen down 30% and has lost over $110 of per share value back down to the $255 level. And I thought now is finally a time to buy the dip on this leading company in the solar space. And if we take a look at SolarEdge Technologies' latest investor presentation, they are actually ranked as the #1 solar inverter company in the industry right now in terms of revenue as of 2020, and they've shipped over 65 million power optimizers and over 2.7 million inverters in the company's lifetime. And right now, they have operations in 28 different countries all around the world. And we all know countries and companies are shifting toward green energy, and solar is a very popular trend, only expected to expand for many years in the future. And all the way up to 2050, they're expecting mass market expansion, and the global population is projected to add another 2 billion people, and energy consumption per capita is projected to grow by 23% by 2050, and the solar energy generation is projected to grow by a massive amount in a factor of 60 from 2015 to 2050. So for this company, going forward over the next 20 to 30 years, their market is only projected to expand at an incredible rate. And they're positioned to operate in both the residential and the commercial market. And their products can actually go with almost any type of building, which is incredibly impressive and really opens them up for mass market appeal. And going forward, the company's total sales are still continuing to grow in the high double digits every single year. And over the past 5 years, they're expanding at a CAGR of 31%. And over the next few years going forward, that trend is projected to continue. And we're going to be going over some analyst expectations for their future revenue expansion. And if we take a look, in 2020, they brought in $1.46 billion of total sales. Their cash flow from operations were at $222 million, and their GAAP net income came in at $140 million. And SolarEdge maintained a gross margin of over 31%. And now we're going to shift over to the company's financial statements to see how they've been progressing over the past 5 years. And we can see, starting off with the income statement, total revenue is growing like we saw from the presentation and throughout 2020, when many companies were not spending a lot of money on capital expenditures due to the pandemic. This company was still able to grow their total revenue to close to $1.46 billion over the trailing 12 months. And what attracted me to SolarEdge is the fact that this company is profitable and has maintained profitability over the past 5 years. Right now, in the solar space, there's a ton of companies burning through hundreds of millions or even billions of dollars of capital every single year just to continue to grow. But this company has proven that they can continue to expand their operations at a rapid rate and still generate positive accounting profits, which is a very pleasant sign as a potential shareholder. And if we take a look going forward, analysts are expecting revenue growth of 27% over this current year, followed by another 25% throughout 2022, where they're expected to hit $2.3 billion of total revenue. And now if we take a look at their balance sheet, they're in a very healthy financial position at this current point in time. They have $1.7 billion of total current assets on the balance sheet as of their latest report, and their short-term liabilities are only at $436 million. So a current ratio right around 4 and extremely sustainable over the short term. And if we take a look at their total liabilities of only $1.35 billion compared to their total assets of over $2.4 billion, I'm very comfortable with this company's current financial position. And going forward, I think they have enough capital in hand to fund their growth over the next few years. And overall, the company's share price is projected to expand by 20% per year for the next 5 years going forward. They are currently ranked as somewhat of a hold or a very weak buy at this current point in time, and the current share price of $255 is below the 12-month expectation of $305 per share, implying another 15 to 20% upside from their current level. So right now, I started a position in SolarEdge Technologies in my smaller high-risk, high-reward portfolio. I purchased 3 shares of this company with an average cost of $242, and I'm already up over 5%. So SolarEdge, or ticker SEDG, was the first company I just bought as of late. There is still a lot of risk associated with this brand. They're still a small cap company. They don't have well-established operations just yet, but I will hold, see if we can get some nice short-term gains, and going forward, hopefully this can turn into a major solar company over the next few years, and the share price will climb to new record highs. And if they continue to fall anywhere around $200, I will pick up a couple more shares and build out this position a little bit further. And now we're going to move away from SolarEdge and take a look at the second company I just bought in this portfolio. This was already an existing holding. It's a small cap brand I do believe in long term, and it is ticker TTCF, which of course is the Tattooed Chef. Many YouTubers right now are discussing this company. Some love it, some hate it. I have this position as the largest holding in this portfolio. I own 100 shares with a market value of over $1,600. And Tattooed Chef took a major fall over the past few days, and I had to buy the dip when it was trading for around $15 per share, and I thought it was at a very attractive level, and at that price, it only had a market cap around $1.2 billion for a company I believe could be worth a lot more over the next few years. So if we take a look at Tattooed Chef over the past year, this is a plant-based frozen food company that hit an all-time high of $28 per share, and from this record back in September of 2020, they have now fallen over 41%, and from their recent high back in early 2021, they are now down 38% from that level as well. So I bought more shares of Tattooed Chef, I added 30 more at a price point right around $15.80, and I will continue to buy if this stock trades anywhere around that $15 mark, because I think that's really cheap for this company. And if you've never heard of the Tattooed Chef brand before, they're a plant-based food company that is still very early on in their growth and has just hit all the major retailers as of late 2019 and throughout 2020. And they offer different plant-based food options for every meal, snacks, and dessert that you could think of. And the company has a very expanding product mix, and by the end of 2021, they expect to have 62 different SKUs available on the market across all of the different meals and snack options you could ever imagine. And their products taste fantastic. I've tried them myself, and I believe the long-term growth of this company is very strong. And if we take a look right now, by the year end 2020, they grew their branded points of distribution by 155% over the 2019 result, and they were in over 4,200 stores all across the nation, and these are some of the biggest retailers, which include Walmart, Sam's Club, Costco, and Target, and the company's total points of distribution were at 23,000. And by the end of this fiscal year, they're expecting to be in 10,000 different stores with over 65,000 total points of distribution. And this company has already expanded as a national brand without any advertising. And just early on in 2021, at the end of the first quarter, the company just launched their first ever ad campaign, when we will see going forward over the next few quarters if that new advertising has led to an increase in total revenue and brand awareness. And one thing I want to note is that late in the first quarter as well, the company just announced that Target, one of the nation's largest retailers, is taking 6 of their products nationwide in every single store, which is incredibly impressive. Not many small brands go nationwide in any retailer, and a brand as large as Target to take 6 different options, which is a lot of freezer space in every single location, is incredibly impressive. And I think over the next few quarters, when we start to see these sales come in, the company will post very strong results. And going forward, I think their e-commerce brand is a hidden secret that many investors and other YouTubers are not focusing on at this current point in time. So they haven't done really too much into e-commerce just yet, but I think that's the golden ticket that's going to lead to very high profitability in a very tight margin industry. When you go into retail, you have to split all the profits with the big box store, and they have pricing control. Because they have the demand and they have the customer, they set very high prices and very low for them. So the company actually takes in a lot of the profits, and the supplier or tattooed chef gets hurt in the terms of margin. But if you can go direct to consumer, you skip that big box retailer and you can retain all the profits into your own company. And I think going forward, a company like Tattooed Chef, although they are shipping frozen goods, which is a little bit more difficult, their target market is the younger generation who already orders everything online. They're targeting the young, the edgy, health-conscious individuals who care about what they're putting in their body, and going for a frozen, very quick, plant-based alternative is definitely going to be attractive for a lot of young names. And to get into the e-commerce space with their attractive and very eye-catching brand and packaging, I think that will work very well in the form of long and consistent e-commerce sales. And with this company, over the longer term, they're trying to create a subscription-based model where every single month you can choose a product to get automatically sent to your home. And I think going forward, if that can continue to grow, that'll be a driver setting Tattooed Chef and making them much larger than where they are right now. And for the next 5 years, they've laid out their future growth expectations for total revenue and their gross margin. And for the full 2021 fiscal year, they're projecting $222 million of total sales, up to $300 million next year, $500 million by year end 2023, and then finally, 5 years out, they expect to do $1 billion in annual revenue by 2026, with a gross margin of over 35%, and I do believe they will achieve this number over the next 5 years. And if we take a look at their current income statement, over the past 12 months, they have generated $150 million of total sales, and their total net income was at $67 million. That was inflated due to a tax benefit where they got around over $42 million in tax benefits, but even without that, the company did maintain slight profitability. And going forward, they're projected to grow their total revenue by 50% in 2021 to around $224 million, and another 36% by 2022, and achieve $305 million of total sales. And if we take a look at their balance sheet, after their equity offering, the company is in a very strong position with $200 million of total current assets and very little debt, and the total liabilities for this entire company only sits at $32 million, which is extremely low. They have a current ratio well above 6 and are very sustainable to operate and fund future expansion with the capital on hand. And they actually have expanded their manufacturing capacity by 100% in 2020, and they have the capacity to double once again to go by 4x from the 2019 level by year end 2021. So right now, I think some people don't like Tattooed Chef, and I understand the reasoning to why that, but I also am a bull on this company. I bought the dip, and I think going forward, the brand will continue to grow, and I think this will be worth a lot more than $1.3 billion. I'm not saying this is going to be a $50 to $150 billion company, but I think I can absolutely see Tattooed Chef growing to be worth 10 or 15 billion over the longer term once their total sales go up to that 1, 2, or 3 billion in the annual mark. And I think Tattooed Chef is a potential stock that I could see 5 to 10x returns over the next few years. So that's the second company that I bought the dip in my personal portfolio. It is now the largest holding in this small cap high growth portfolio with 100 shares with a total value of over 1,600. And at this current level, I am down 7.6%, but not worried whatsoever. So that was the second company I just bought as of late. And now we're going to wrap up the video. In this episode, we took a look at Tattooed Chef and SolarEdge, the two brands I just bought in this portfolio. They're very small cap companies. SolarEdge worth around 12 billion, Tattooed Chef only worth around 1.3. They both have the potential to grow. They operate in expanding markets, and although they come with a lot more associated risks, I'm willing to take the gamble, and hopefully over the next few years, we can see some nice share price appreciation and lock in some nice profits when we do eventually sell. So thank you for watching to the end. I am the Gen Z Investor, and I will see you in tomorrow's video.